With EAM surging near 52-week highs and, flashing strong buy signals across the board, some are calling it drastically undervalued. But, and this is a big but yield, with technical indicators literally screaming overbought, is this a genuine long-term breakout or just a classic value trap waiting to catch an unsuspecting retail trader?
Honestly, it is the defining market puzzle right now. I mean, you have this massive collision of immense institutional capital, geopolitical tension, and just screaming technical data. We are talking about a fundamental shift in where the world's money is flowing.
Right, and that is exactly what we are going to tear into today. Welcome to the Deep Dive. We're thrilled to have you here with us. And hey, just a quick but crucial reminder before we begin. You got to like the video, subscribe to our YouTube channel, and you absolutely must leave us your comments and feedback down below.
Yeah, we really want to hear what you think about this one.
Exactly. Also, just to be clear up front, what we are doing here is a natural human debate and an analysis of market data. We're going to look at the landscape, figure out how the mechanics work, but this is not financial advice.
Right, no financial advice here. The goal is really to give you the context to think critically about what the data is actually saying, because the surface level, especially when it comes to international equities, is, well, it's rarely the whole story.
So true. So our mission today is to thoroughly unpack the iShares MSCI Emerging Markets ETF ticker symbol EEM as it stands right now in mid-April 2026. We are diving into real-time market data, the underlying technical analysis, and this massive, almost seismic capital rotation that is, actively reshaping global portfolios.
It really is a massive shift.
It is. But before we get into the psychology of why all this money is moving, I wanted to establish the baseline. As of the close on April 14th, 2026, EEM is sitting at $62.24. When I look at the 52-week range, it's been as low as 41.43 and as high as 65.96.
That is a huge spread for a broad ETF.
Right. The bullish trend here is undeniable. We are up about 11.6% year to date. And zooming out to the last 12 months, it has surged roughly 49.8%.
Yeah, and your 50% run in an emerging markets index over a single year is, well, it's staggering. It reflects a profound shift in global risk appetite.
Okay, let's unpack this, because I am looking at a dashboard of technical indicators right now, and they are all just glowing green. They say strong buy. But for those of us who don't, trade on a terminal all day, what does that actually mean mechanically?
Sure.
I see that the price is trading well above its 50-day moving average of 59.60 and well above the 200-day moving average of 57.79. Why do those specific numbers trigger a strong buy in the broader market?
What's fascinating here is how algorithmic trading actually dictates the market momentum. When you hear moving average, think of it as the smoothed out consensus of what the asset is worth over that time period. The 200-day moving average is basically the ultimate line in the sand for institutional trend followers. When a price crosses above that, it mechanically triggers buy programs at massive hedge funds.
Wow, just automatically.
Exactly. It signals that the long-term trend has definitively shifted from bearish to bullish. And because EEM is trading comfortably above both the 50-day and the 200-day, those price levels around $59 and $57 flip from being ceilings that the price couldn't break through to floors.
Oh, I see.
Yeah, they become structural support zones. You'll also see secondary support levels at 59.22 and 57.82.
Meaning if the price dips, algorithms and institutional buyers are programmed to step in and buy at those exact levels.
You got it. They view a dip to 59 not as a crash, but as a discount entry point into a confirmed upward trend. And we can see this momentum in the MCD too, the moving average convergence divergence, which is sitting at a very positive 0.78.
Right.
That is why the immediate resistance levels, the ceilings it needs to break next, are 62.59 and eventually that 52-week high of 65.96. The path of least resistance, structurally speaking, is just up.
But I'm looking at another metric here, and it feels like a glaring, flashing red light. The RSI, the Relative Strength Index, is sitting at 77.43, and EEM recently broke completely through its upper Bollinger Band.
Yeah, that's where it gets complicated.
Right. Now, I know an RSI over 70 is officially considered overbought, but
Okay.
explain the mechanics of that. Why should a high RSI make me nervous if the overall trend is so strong?
To understand RSI, you have to think about the velocity of the price change. RSI measures the speed and magnitude of recent price shifts on a scale from 0 to 100. It doesn't tell you where the stock is going in a year. It tells you how much energy was just expended to get to the current price.
Okay, that makes sense.
So when an RSI hits 77, it mathematically indicates that buying pressure has dramatically outstripped historical norms for this specific time frame.
So it's essentially measuring market fatigue.
That's a great way to think about it. And when you combine that with the Bollinger Band break, the picture becomes a lot clearer. Bollinger Bands map the standard deviation of price movements. Basically, they draw a statistical highway that the stock normally travels on.
Right.
Breaking the upper band means the price just drove completely off the shoulder of the highway. It is a statistical anomaly.
It makes me think of an engine redlining in a high gear. Like the car is moving incredibly fast, the momentum is undeniably strong, but if the driver doesn't shift gears and let the RPMs drop, the engine is going to blow.
That is exactly it.
So a short-term pullback isn't just possible here. It feels like the mechanics of the market are demanding that the asset consolidate before it can actually move higher.
That redlining analogy perfectly captures the tension between the long-term trend and the short-term exhaustion. Reconciling a long-term strong buy on the moving averages with immediate short-term weakness on the RSIs, it's actually the hallmark of a mature trend. Yeah, it means the asset has moved too far, too fast, and those algorithmic programs are now primed to take profits, which drives the price back into that normal statistical highway. So yes, the technicals scream long-term strength, but they absolutely demand short-term caution.
Okay, so if the engine is redlining, I want to know who is pressing the gas pedal. Let's look at the order flow, because the sheer volume of money moving into EEM right now is incredible.
It's massive.
The data shows huge institutional and retail buying. On the moving averages, it is 12 buy signals and 0 sell. On the technical oscillators, 8 buy, 0 sell. And JP Morgan is projecting up to $50 billion flowing into emerging market funds in 2026 alone.
Which is a tidal wave of capital.
Exactly. So what is the narrative driving this specific rotation? Why EM?
The prevailing narrative on Wall Street right now is calling this the anti-AI and dollar weakness rotation. The idea being peddled is that investors are exhausted by the no-bleed valuations of U.S. mega-cap tech names.
Right, the Magnificent Seven stuff?
Exactly. They feel that the artificial intelligence trade has become too crowded, too expensive, and just too risky. So capital is hunting for relative value. They're looking for assets with lower price-to-book ratios and actual dividend yields.
And EEM definitely fits that profile.
Yep.
When you look at the financials, the ETF equivalent to a balance sheet and cash flows, this fund has net assets of $26.86 billion, a price-to-book ratio of just 2.39x, and it pays a trailing dividend yield somewhere between 1.94% and 2.16%.
Right, and that dividend is distributed semi-annually.
Yeah. I can definitely see why an institutional portfolio manager looking to balance out risk would find that attractive compared to, U.S. tech stock trading at 40 times sales.
If we connect this to the bigger picture, it is a textbook rotation. Capital flows like water. It's always seeking the path of least resistance to yield.
Here's where it gets really interesting, though. I am looking at this narrative, and it feels completely contradictory to me. Well, Wall Street is calling this an anti-AI rotation.
Yeah.
But if we actually open up the hood of the EM ETF and look at its top holdings, over 13% of this fund is Taiwan Semiconductor-TSMC. Another 5 to 6% is Samsung. About 4% is Tencent.
The undeniable heavyweights of the Asian market.
Right. But TSMC and Samsung literally manufacture the physical silicon chips that power the entire global AI revolution. I mean, NVIDIA designs the chips, but TSMC actually makes them.
That is a very good point.
How in the world can anyone call this an anti-AI trade when nearly 20% of the fund is concentrated in the absolute bedrock of AI infrastructure? I'm genuinely confused by this narrative. Are we just dealing with flawed marketing here?
This raises an important question about how Wall Street packages ideas. Your instinct is spot on. Calling it anti-AI is a gross oversimplification. What we're really witnessing is a rotation driven by the hunt for relative value.
Meaning they still want the AI exposure, they just don't want to pay the U.S. premium for it.
You nailed it. Institutions aren't saying AI is over. They are saying NVIDIA and Microsoft have gotten too expensive to justify putting new money to work there today. So how do I buy the infrastructure of AI at a cheaper multiple?
Ah, I see.
TSMC and Samsung are the picks and shovels of the AI gold rush. Because they are categorized as emerging markets, they trade at lower valuations than their U.S. counterparts. EEM gives institutions a way to own that massive growth story without paying the U.S. megacap premium.
Wow.
Yeah, it is entirely a backdoor tech trade disguised in a sensible, diversified emerging markets wrapper.
That makes so much more sense. It's not a rejection of tech. It's just buying tech on the discount rack.
Yeah.
Which perfectly tees up the most hotly contested debate surrounding EEM right now, its valuation. Because when you hunt for relative value, you inevitably have to ask, is this an undervalued gem or is it a value trap?
And that distinction is what determines whether you build wealth or destroy it in international markets.
So let's look at the actual multiples. EEM currently trades at a PE ratio, price to earnings of roughly 11.5x to 17.3x, depending on whether you are looking at forward estimates or trailing metrics.
Right.
Either way, that is significantly lower than its own 5-year average of 18x. And when I look at the S&P 500 trading at massive premiums, an 11.5x multiple makes EM look incredibly cheap. I mean, it looks like a steal.
On paper, it is a siren song for value investors. A low PE ratio is designed to signal that you are paying less for every dollar of earnings a company generates.
But I know that a low price tag doesn't automatically mean a good investment. Retail traders often look at that low PE, think they're getting a massive bargain, and just jump in. Then 6 months later, they are down 20% and wonder what went wrong.
Exactly.
How does a value trap actually function mechanically? Why does something that looks mathematically cheap suddenly become a disaster?
To understand a value trap, you have to remember that the PE ratio is a fraction price divided by earnings. The trap occurs when a stock or an index appears cheap because the prices come down, but the market is anticipating that the earnings is about to collapse even faster.
Oh, I see, like stepping onto an escalator going down. You might have bought a cheap ticket to get on at step 10, but the entire staircase is descending beneath you.
That is a brilliant way to visualize it. If you buy at a PE of 11.5x and suddenly the companies in that ETF lose major contracts or face a recession, their quarterly and annual income statements take a massive hit. Their earnings plummet.
Right.
Suddenly the math recalculates. The earnings drop so much that your 11.5x multiple balloons to a 25x multiple overnight without the stock price ever going up. What looked cheap becomes structurally expensive.
Wow.
Yeah, the trap is that the deep discount was actually the market accurately pricing in future pain.
So for EM, we have to look past the surface level PE ratio. We have to ask what structural mechanisms are driving the earnings and what risks might justify why the rest of the world is willing to sell this to us at an 11.5x multiple.
Exactly.
Let's stack them up. Let's put the absolute best case recovery scenario head to head with the worst case continuation lower. Let's start with the bulls. What are the macro mechanics pulling that projected $50 billion into this space?
Well, the biggest macro tailwind for the bull case is definitely the U.S. dollar. The DXY, the dollar index, has been trending down, dropping below 100 recently.
Now, I know that a weak dollar is generally good for emerging markets, but walk me through the actual mechanics of why. How does the value of a dollar in New York directly boost the profit margins of a company in Brazil or Taiwan?
It comes down to debt and revenue translation on their balance sheets. First, the debt. Many emerging market governments and corporations borrow money denominated in U.S. dollars because it's the global reserve currency.
Okay.
If the U.S. dollar weakens relative to their local currency, it suddenly takes fewer of their local pesos, reals, or won to pay back that dollar-denominated debt. Their debt servicing costs mathematically shrink, instantly freeing up cash flow.
It's like getting a spontaneous reduction on your mortgage rate just because currency exchange rates fluctuated.
Exactly. And the second mechanism is revenue translation. The ETF is priced in U.S. dollars. When the companies inside EM make profits in their local currencies and the dollar is weak, those local profits translate into more U.S. dollars. It acts as an artificial multiplier on their earnings growth.
Oh, that makes total sense.
Add in the expected multi-year catalysts of Federal Reserve rate cuts, which generally put further downward pressure on the dollar, and you have a massive structural tailwind pushing emerging market valuations higher.
And the second engine for the bull case is the China recovery. EM has heavy exposure to China, roughly 25% of the fund. We mentioned Tencent and Samsung earlier. Companies in that region are currently forecasting around 15% earnings growth.
Right.
If the Chinese economy fully re-stimulates and reawakens, EEM rides that wave directly on its balance sheet.
It is a highly compelling thesis. The macro mechanics align perfectly for growth, but, the bear case is equally potent, and it centers on the exact same geography and volatility.
Yet the flip side of having 25% in China and over 13% in Taiwan is blinding geopolitical risk.
Yeah.
I mean, you have extreme concentration in the single most geopolitically sensitive region on the planet.
Without a doubt.
Furthermore, emerging market assets are notoriously volatile when it comes to global fear. Let's talk about the VIX. When the volatility index spikes, Why do emerging markets always seem to get hit the hardest?
It's a mechanism of liquidity and risk tolerance. Emerging markets are considered high beta assets. When global fear rises, when the VIX spikes, institutional investors immediately engage in capital
You
flight.
just pull everything.
Exactly. They pull their money out of the riskiest, least liquid markets first and park it in safe havens like U.S. Treasuries. Emerging markets don't just drop because their fundamentals change. They drop because the liquidity completely evaporates from the order books. When Wall Street panics, emerging markets suffer immediate, amplified downside repricing.
So what does this all mean for the retail investor? We have discussed the geopolitical risk and the volatility risk, but honestly, there is another underlying risk that frustrates me even more and is built right into the fund structure, the fees.
Ah, the expense ratio.
Yes, EEM has an expense ratio of 0.72%. Now, in a vacuum, maybe you don't notice that,
Mm-hmm.
but there is a core version of this exact same fund offered by the same issuer IMG that charges just 0.09%.
Yeah, that is a big difference.
By the way, IEMG tracks slightly different market cap weightings, but they are functionally very similar vehicles for EM exposure. Why would anyone pay 0.72% when a 0.09% alternative is sitting right there? It feels like agreeing to pay a massive premium on your car insurance for the exact same coverage. Over a decade, that fee drag will absolutely hollow out your compounding returns.
You are absolutely right to highlight the fee drag. Mathematically, over a 10 or 20-year investment horizon, paying 0.72% instead of 0.09% is going to eat a massive guaranteed hole in your total return. It is an undeniable structural negative.
Thank you.
But, and this is a big but, if we are truly analyzing the unique risk profile of EEM, we have to keep our priorities straight. The fee is a slow, predictable leak in the tire. The geopolitical concentration is the risk of the entire car driving off a cliff.
Okay, that's a stark way to put it.
Think about the actual mechanics of a geopolitical event. If tensions escalate in the Taiwan Strait, or if severe sweeping trade sanctions are levied against the Chinese tech sector overnight, EEM isn't going to slowly bleed 0.5% in fees. It could gap down 20 or 30% in a matter of days.
Right.
If that region experiences a real political shockwave, the expense ratio of the fund is like worrying about the inflation rate on your fire insurance premium when your house is built directly on top of an active volcano.
Okay, that puts it into perspective.
Mm-hmm.
The fee is a certainty, but the geography is the existential threat. So taking all of these complex mechanics into account, the algorithmic trading signals, the backdoor AI rotation, the dollar-debt correlation, and the geopolitical volcano, what is the actual timeline here? Where is the trajectory of this fund heading?
We have to split this into two distinct horizons, short-term and medium to long-term. In the short term, meaning days to weeks, we are looking at highly probable weakness and consolidation.
The engine needs to downshift.
Precisely. With the RSI pushing 77 and that upper Bollinger Band broken, technical gravity is almost certain to take hold. Algorithmic profit-taking is going to pull the price back into that normal statistical band.
Makes sense.
A minor pullback isn't just a risk, it's practically a structural requirement for the health of the broader trend. Buyers will likely be waiting to step in at those $59 moving average support levels we discussed earlier.
And the medium to long-term outlook.
The medium to long-term perspective remains highly bullish. If the macroeconomic narrative holds, specifically, if the U.S. dollar continues its structural decline and the Fed follows through with a sustained cycle of rate cuts, it provides a massive multi-year runway for emerging market corporate balance sheets to expand.
So that $50 billion is just the start.
Yeah, the $50 billion in capital inflows projected by J.P. Morgan suggests that institutions are positioning for a secular multi-year shift, not just a quick seasonal trade.
So we wrap this up right where we started, but with a fundamentally deeper understanding of the mechanisms at play. EEM right now is caught directly between short-term algorithmic exhaustion and massive long-term macro tailwinds. It is a backdoor AI trade disguised as a valued diversification play, sitting squarely on a geopolitical fault line.
It really is the ultimate test of an investor's timeline and risk tolerance. But, I want to leave you with a final thought to mull over, especially if you hold emerging market assets in your own portfolio as a way to diversify away from U.S. risk.
Let's hear it.
The entire bullish thesis we've discussed today rests heavily on a relatively smooth geopolitical environment in Asia and a functional global supply chain. Wall Street sells you EEM as diversification away from U.S. tech.
Right.
But think about the mechanics of the semiconductor industry. TSMC and Samsung don't exist in a vacuum. They fabricate the chips that Apple, Nvidia, and Microsoft rely on to survive.
Oh, wow.
If a geopolitical event in Taiwan crashes EEM, the U.S. tech sector will inevitably crash right alongside it due to supply chain paralysis. So ask yourself, are you truly diversified by buying an emerging markets ETF? If its massive tech holdings are inextricably tethered to the exact same global supply chains as the U.S. market you were trying to diversify away from.
That is the real question. When the supply chains are global, the risk is global. Thank you for joining us for this deep dive. Keep questioning the data, keep looking beneath the surface to understand the mechanics, and we will catch you on the next deep dive.